Net present value, NPV. Concept and calculation process. Net present value, NPV, is the cornerstone of discounted cash flow analysis. It calculates the difference between the present value of future cash inflows and the initial investment, discounted at the firm's cost of capital. Mathematically, NPV equals sigma, cash inflows divided by 1 plus R, initial outlay. A positive NPV indicates that a project adds value to the firm, while a negative NPV suggests wealth destruction. The method fully incorporates the time value of money and risk-adjusted returns. By converting future inflows into present equivalents, NPV provides a clear measure of expected value creation. This makes it the preferred criterion for evaluating strategic investments under certainty and risk. Strengths and advantages. NPV's greatest strength lies in its direct link to shareholder value. It quantifies absolute wealth created, aligning decision-making with the firm's primary financial objective. NPV considers both magnitude and timing of cash flows, discounting future benefits realistically. It is versatile, accommodating various risk levels through adjusted discount rates. Moreover, NPV handles complex cash flow structures and allows integration with real options and scenario modeling. Unlike IR or ARR, it avoids reinvestment and multiple solution problems. Because it expresses results in monetary terms, NPV provides an unambiguous acceptance rule: accept projects with positive NPVs. This clarity makes it the most theoretically sound appraisal technique. Weaknesses and limitations. Despite its robustness, NPV requires accurate estimation of cash flows and discount rates, which can be challenging under uncertainty. Small changes in discount rates may significantly alter outcomes, especially for long-term projects. The method assumes that the discount rate remains constant, which may not reflect fluctuating economic conditions. NPV's reliance on absolute figures also complicates comparison across projects of varying scales. Furthermore, non-financial or strategic benefits are excluded unless quantified. As such, NPV, while precise, may underrepresent qualitative factors like brand reputation, innovation, or environmental impact. Therefore, managerial judgment is essential to interpret results within broader strategic context. Appropriate usage. NPV is appropriate for evaluating independent and mutually exclusive investments where maximizing shareholder wealth is the objective. It is especially relevant for long-term strategic projects and capital-intensive industries where timing and risk matter. NPV facilitates cross-border investment appraisal by incorporating risk-adjusted discount rates that reflect market and currency risk. It also underpins advanced methods like discounted payback, real options, and value-based management. For projects with comparable risk and scale, NPV provides an objective ranking mechanism grounded in financial theory. Its adaptability and precision make it indispensable for modern corporate finance. Comparison with other techniques. Compared with payback and AR, NPV is superior because it recognizes the time value of money and cash flow realism. Against IR, it provides an absolute rather than relative measure of profitability, avoiding ambiguity in ranking projects of different scales. However, IR's intuitive percentage format makes it a useful companion measure for communication purposes. While Profitability Index, PI, helps with capital rationing, NPV remains the fundamental measure of value creation. When combined with scenario or sensitivity analysis, NPV provides a robust framework for evaluating investment alternatives under uncertainty. Role and prioritization of mutually exclusive projects. When projects are mutually exclusive, NPV provides the most reliable ranking criterion. The project with the highest positive NPV should be selected, as it maximizes total shareholder wealth. In cases of capital rationing, Profitability Index or incremental NPV analysis aids prioritization, ensuring optimal portfolio selection within financial limits. NPV also integrates easily with real options thinking, allowing flexible reassessment as information evolves. Although it requires sophisticated estimation and data, NPV's theoretical soundness and strategic relevance make it the dominant tool in investment appraisal. It ensures that every capital decision contributes directly to long-term value creation.